The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm edition of Scorebox ahead. Warm edition, warm welcome to this edition. It could be either you like. Anyway, Carolyn Roth's with me as well. There she is. Good morning to you.
Good morning.
A warm edition to you too. These are your headlines. It's got a hot sell-off. Global stocks roiled. The Nikkei tracks towards its worst day in more than 4 years. After a rough session on Wall Street sees stocks solidly in the red. Amazon sinks on the back of its first revenue miss in nearly 2 years, whilst Apple overcomes a lag in China to post a 5% sales boost.
Intel shares plunge as the chipmaker reports worse than expected results and weak guidance and says it will cut 15,000 jobs as part of a $10 billion cost reduction plan. Meantime, AXA announcing talks with BNP Paribas to sell its asset management business in a deal worth 5.4 billion euros as the French insurer aims to refocus on its core business.
And the Bank of England cuts rates for the first time since 2020, voting 5-4 in favour, with the Governor Andrew Bailey pledging caution ahead.
I think the direction of travel is, to my mind, pretty clear. In terms of, I hope we'll be in a position to see that restrictiveness come out over time. But I'm not going to make any predictions about speed or timing.
It's going to be one of those shows. I'm still laughing at my own mispronunciation. A warm edition. I like that. I think
it's a Freudian slip.
How the hell are you?
I'm well? Good. How are you? I haven't co-anchored with you in years.
You lucky sausage. There's people still in therapy having worked with me for that long as well. Half the people who aren't here now are still with the company. They're just having a break from me. Lovely to see you anyway. I'm sure we'll have a lovely time today as well. Look, it's one of those sessions where I looked at what the headlines are and I looked at what our brilliant team of producers led by Michael and Katie today, and what they've written about, and I'm always questioning, I'm thinking, is that reason why we came off as well? So I'll go through what the narrative is, and then we'll go on from there and we'll have a good chat about this, because the Dow dropped 500 points on Thursday, spooked, by recession fears after data showed a worsening economic outlook. Hold that thought. Worsening economic outlook. Now, the ISM manufacturing PMI showed factory activity fell into contraction in July, coming in weaker at 46.8. Now, we've had a run of poor data on that front as well. But anyway, initial jobless claims hit an 11-month high, with attention now turning to today's absolutely pivotal, as ever, non-farm payrolls report, with the US economy having expected to have added 185,000 jobs in July. So that's the data. And this is my point, Carolyn, as well. You have been doing, I don't know when you first joined CNBC, but you've been a lot coming in and out. You look timeless as ever as well. It's almost as if you just came in, but you've been with us a long time. And you've had your breaks and your family and everything. But and how many times have you and I and the team pontificated over it? Is good data, bad data, good data, good data, bad data, bad data?
Well, now we're back to bad data being bad for, bad is bad.
But that's not the narrative, isn't it?
Well, it has been the narrative maybe a couple times, and now the market is becoming picky again. But I had a guest on the other show, Street Science, the other day, Jeffrey Yu from BNY Mellon, and
love Jeffrey,
we all love him. But he warned me about this: the bad data, the bad news becoming bad news for the market once again. And he also added a massive repricing is underway, and this is exactly what we're seeing, because the market is wrapping its head around the fact that, hey, some of the data could actually be bad, and we're not just excited about these big rate cuts coming from the Fed. So that means a lot more volatility, according to Jeffrey Yu. And the massive repricing that we've seen in terms of Fed cuts since the start of the year, that will only accelerate.
Yes, absolutely. And let's be brutally honest about it. Some of the geniuses at the investment banks and elsewhere They've been so wrong about when the first rate cut happens. And now they've penciled it in. They pretty much think 100% we're going to get it in September as well. Perhaps with the Bank of England going as well, it's kind of just added to that groundswell that the Fed's going to do it. But as you say, is the Fed getting behind the curve? Is bad data now actually what they're worrying about? Forget about inflation. We've done that. We've finished worrying about that. Now we're worried about the underlying economy.
You know, I do worry, and I think the market worries as
working
well.
with me?
Well, worried about you and about, but. Look, 2 years ago, the Fed was way too late in terms of raising interest rates when inflation was so high. What if they're too late? What if they're behind the curve once again? If the economy softens way too much, the consumer, we've seen some patches of weakness, and we'll talk about that during the show.
Yes, we have.
What if they're too late? What if they're behind the curve again in terms of the easing cycle?
Plus the fact, I just want to say, and we've got the US markets here as well, and we'll run through a few of these as well. This is the US markets where they fell yesterday. Interestingly, if there was a fourth bar, I'd put the Russell 2K on there, which actually outpaced to the downside all of these moves. And I think that's interesting as well, because it's about the valuations of the big tech story. It's about beating very high elevations in order to justify those valuations. But what I thought was fascinating is what you've been able to rely on in recent weeks is this stunning rally in other stocks when tech stocks fell. So you've had this historic outperformance of the Russell 2K, but the Russell 2K outperformed to the downside yesterday. So there was no great rotation for you apart from into some of those treasuries. But you've been looking at the big tech as well.
You've been looking at the big tech. In fact,
is it me?
Steve, that's your name.
Oh, okay. I just see big tech, Carolyn. Okay, I told you it's going to be one of those days. Let's have a look at big tech. I've been looking at big tech. There you go. I'm looking at it. Meta up 23 points. We don't worry about metaverse anymore. Do you remember that was yesterday's story? What we really get excited about is their advertising revenues. We don't worry about the spending on AI. We don't worry about spending on metaverse. We just like their ad revenues, and that's why they're up 5% as well. The rest of them, we are worried about the AI spending. And look, if you go through the numbers of Amazon and Apple in the last 24 hours, there was a lot to like. If you're a longer-term investor, and we'll speak to Josh Corrin in a few moments, there is a lot to like about these companies, really. I mean, some of the numbers. But it's just nitpicking at the sides, plus the fact we had the Intel news, which we haven't barely even talked about as well. Now, well, you've been looking at the treasuries. There you go. That's definitely you.
And we did see a lot of buying, no surprise here, given the safe haven flows both into the dollar, but also when it comes to the treasuries, and the yield correspondingly dropping back below the 4% level, the handle for the first time in 6 months. And we're seeing that the yield overall, 3.96%, that is also a 6-month low. And we saw that steepening. Take a look at the 10-year, 4.14%. So again, the inverted yield curve, is that indicating a recession? Though it has done that, Steve, for the last 2 years, and it never happened.
Recession indicator of the last 5 years, isn't it?
I think we should simply forget about it. Let's move on to the dollar crosses, though, because what we're seeing here is a lot of safe haven buying as well, even if the U.S., ironically, was the reason for concern. The dollar, euro dollar, 107.97. And of course, we're seeing some yen strength coming back.
Can I just say one more thing before we get JP on? Can we take that strap off and we have a look at my feet? Can we do that? There you go, look. So I had my Friday shoes on. I called my Arabella Gamadis. But then they all looked at me. All the producers looked at me and go, oh, you're going to the wall. I think they literally mean it. So now I've had to put a pair of proper black brogue type shoes on.
Well, you could have just left on the other shoes. Why not? Arabella does it.
I'm not trying to be trendy like him.
Wow.
Different age group.
All right. Shall we talk about the Asian market? Because we have seen, once again, a lot of volatility in the Nikkei. And I think one of the stats that stood out to me, JP, I'll bring you in here, was the volatility for the Nikkei, 28%. And that has a lot to do with the uncertainty given the further outlook for BOJ. Let's get out to JP.
Where is he? Oh, he's there.
Well, good morning to you guys, and not a great morning out here in Asia, actually, with the sell-off really following lockstep what we saw out on Wall Street overnight. You mentioned the Japanese market, so let's start off there because they arguably felt the biggest brunt of that sell-off. You'll see the Nikkei 225 falling by about more than 5% so far in today's session, and continuing as we head to the close out in Japan. Now it's down to that stronger yen, you're right, and it's for multiple reasons why the strong yen and the BOJ's recent decision to hike rates really sapped market sentiment in in Japan. On one hand, that stronger yen, we know it's not seen favorably by Japanese equities, that the inverse relation with the stronger yen not really boding well for Japanese exporters, which dominate the Nikkei 225. But we also have to remember that there's also that carry trade with a lot of folks actually shorting the yen to finance some of these carry trades. If the yen starts to go on this stronger trajectory of strengthening over the long term as the Bank of Japan hikes rates, we might have to see a lot of folks actually covering some of these short positions on the yen and trying to unwind these carry trades, which is why we're seeing a bit of a sell-off on some of these stocks that did quite well for Japan out in Japan over the last year. You see banks here also not doing well, despite hopes that those higher policy rates in Japan might help their net interest margins. Keep in mind that MUFG, one of the biggest banks in Japan, did say that they saw better profits in their fiscal first quarter because also of that weaker yen that boosted the bank accounts of their exporters. Well, that stronger yen might also mean that that particular support for earnings for MUFG might be removed. And we saw MUFG's stock actually fall by more than 10% so far in today's session. We take a look also at greater Asian markets, and everyone from Shanghai to Seoul, they've all also fallen. And you can say a lot of the headwinds are all American, of course, with that very dour ISM report pointing at a downturn in American manufacturing, and also the prospect again of perhaps a sour economic outlook for the U.S. also carrying over and just keeping everybody cautious in the region. We also have those earnings reports, especially the ones from Apple, that really caught a number of the Apple suppliers listed out here in Asia off guard. Sales impressing and actually coming in slightly above estimates, but it's that decline in iPhone sales in China that really sapped sentiment for a number of these. Take a look, for instance, at Lookshare. They're the producer of AirPods. If you have AirPods, they're probably produced at the Shenzhen-listed manufacturers' facilities across mainland China. They're down by about 1.3%. Taiwan Semiconductor, Huanhai, or Foxconn, the major assembler of iPhones, down by about 7.2%. We also see that the likes of SK Hynix in South Korea falling by almost 10%. And Samsung, as we know, not just a big competitor of Apple, but they're also a major supplier of Apple's, particularly for the iPhone. They're also down by about 3.9%. We're getting reports from Korea Business Daily, actually, that it seems that the weeks-long strike hitting Samsung Electronics has been brought to an end. But the labor union said they are now going to shift towards long-term tactics, which they said might include guerrilla strikes and compliance actions. So there's still a lot of uncertainty surrounding Samsung, but today there are a couple of the focus really is the downturn brought about by concerns and uncertainty about the United States economy. Guys, it's back to you and good morning.
Good morning, and thank you very much indeed for that, JP. Lovely to see you, sir. Right, Apple moves slightly higher in extended trade. It did oscillate quite a lot along the flat line if you watched. It posted a beat in the fiscal third quarter with revenue and earnings per share both above analyst estimates. iPhone sales, which make up almost half of the company's top line, came in a bit higher than expected, but dipped around 1% on the year. I tell you what was amazing is, as well as SaaS, everyone got very excited about iPads. When's the last time people got excited about iPads? Seriously, it was part of the drill. Amazon trading sharply low in extended trade after posting its first revenue miss since October 2022. Future prospects also leaving investors cold after its sales forecast came in light for the next quarter. CFO Brian Osalski pointed to a busier than usual news cycle as a headwind for the company, saying customers only have so much attention. Arj joins us with more. Hello, how are you?
Good morning, Steve. Very well.
Good. There was a lot to like in these numbers. There was a lot to like in what Apple had to say. It's certainly a lot to like in some of the Amazon figures are huge. Net total sales, $85.8 billion, up from $81.8 in the second quarter. On another day, this company would have surged, wouldn't it? What did they really not like?
Well, I feel like a broken record, but it's what we've been saying all earnings season.
Welcome to my world. I've been doing it a quarter of a century on this channel. Trust me, I've only got 4 jokes.
But look, it's what I've been saying for this whole earnings season. What the market wants was strong guidance, wants to see costs under control, but yet investing in AI in the future, and wants to see growth. And I think the issue with Amazon is that guidance in particular was light, both on the revenue front, on the income front. Spending, the company saying, is going to continue to increase into the second half in the year. And the e-commerce business as well showed some weakness. The company saying that consumers are opting for sort of lower price goods as well. And perhaps that speaks to some of the competition it's seeing from some of the Chinese players like Shein and Temu as well, which is owned by PDD. And of course, coming into this, the expectations were incredibly high. There was a 21% run up in the stock. So I think what we saw with Amazon is the sort of slight disappointment in some areas really sort of led to that sort of big outsized move after.
Okay, I'll tell you what we'll do. We'll get another view on Amazon and on Apple as well. But I mean, let's get Josh Corrin, a founder and CEO of Musketeer Capital Partners, who joins Carolyn, Arjun, and myself. Hey, Josh, lovely to see you, sir. Look, Arjun said it's had a 21% run up this year. It's actually had a run up from $84 at its low at the end of 2022. And as you point out, there's a lot of crowded longs on some of these techs here. It's not that people don't like the companies, they just don't like the entry point potentially.
Yeah, absolutely. Well, first of all, thank you for having me back on the show. I really appreciate it as always. And exactly like you said, so there's a couple of issues here. First of all, the name is crowded, it's expensive. And if you kind of take a step back and think about it, right? These companies are huge. So when you think about a multi-trillion-dollar company that already is such a large percentage of the index, right? How much bigger is it really going to get, and how much differentiated is that, right? So within the Amazon report, you've got some highlights. AWS grew 19%. That acceleration is continuing. People like that. The street was at 18%, right? But the retail business missed. And is it a coincidence that that happened coinciding with the weak U.S. economic numbers this morning? Now, Amazon would tell you that it is, but we would think that it's not. Why? Because when you have a company like this that is that big in a market that is fully penetrated, right? What does it become? Macro. So if you think about the macro cycle that we have now, over the past couple of years, we had high rates. So we had people fly to quality names, getting growth from the economy, staying away from duration because rates were high. So those valuations were low. Now you have the economy slowing down. So guess what happens? Amazon guides down at a full valuation while it's crowded without very much room for upside left. So what does this do? This reinforces the rotation that we've been seeing into the Russell and continues this funds flow shift in the small to mid caps. For example, a name that we own, Jumia Technologies in Africa, we'd much prefer to own versus Amazon. It's a secular TAM duration story, whereas Amazon is macro cyclical. So we just think that that's going to continue. And we think that as the economy slows down, a business like Amazon, like Apple, they're going to slow down as well. And that's what you're seeing in the earnings.
Josh, I think you make a really excellent point here about these two names increasingly becoming big macro plays. And when we take a look at the bigger macro picture in the U.S., but also globally, we've seen some softness when it comes to the consumer. But again, that kind of begs the question, Apple is very much hoping for consumers to upgrade their iPhones to incorporate some of the new AI features. Well, if the consumer is soft, do they really have that extra cash in their pocket to upgrade their iPhones?
Good point. And then let's add another thing to that, Chinese competition and just competition in general, because you can get a lot of these smartphones that have AI capability for a fraction of the price out of the Chinese market or just away from Apple. So I think that you will always have this Apple fan base. Apple has a ton of quality to it, right? And that will always be there. And therefore, there are always going to be people that are willing to spend discretionary income to upgrade the iPhone. But as more and more competition comes into the market, prices overall come down. You can find these features elsewhere, right? It kind of goes back to your point. Is it really mission critical for consumers in a slowing economy to spend more money on an iPhone relative to anything else? Combined with the fact that smartphones are fully penetrated, and really so is Apple. So we think that story is there. I think in the guide, sell side seemed to think that it implied about 3% iPhone growth going forward. It was kind of like a breakout guess. So you're getting some of that growth, but we don't think that like the upgrade cycle for Apple iPhones is the best growth story out there. In fact, we think the most interesting thing that came out of both of these reports were the CapEx guides and what that means for some of these semiconductor stocks that have gone down 30 or 40% over the past month. Those fundamentals look really healthy while the stocks are on the ground. But these other big cap tech names are just slow.
Josh, it's Arjun here. Good to speak to you again. Can I just address what you mentioned there around Chinese competition? Because at the moment, it's become relevant to both Apple and now Amazon as well. And I just want to get your take on what we can glean from these numbers about Chinese competition. First, from Apple, we saw Greater China revenues decline, and we know there's been a resurgence of Huawei. Firstly, how big a deal is that for Apple in China, particularly with Huawei playing in the high end of the market where Apple plays? And secondly, with Amazon, we've seen such an explosion of interest and use of Temu, of Shein, and some of the other low-cost Chinese e-commerce plays. How big a threat is that to Amazon's core e-commerce business?
Absolutely. Arjun, great to hear from you again, and it's always great to chat with you. So a couple things. First, let's start with Apple. In China, even more of a threat, right? Less discretionary income, more competition, more access to the competition, and the competition is cheaper because you don't have to ship it halfway around the world to get access to it, right? So it's definitely a threat. And we think that going forward is just like Moore's Law. As time evolves, as technology pricing starts to come down, more and more competitors will adopt it, right? That will only get worse for Apple going forward, where you don't really have such intense brand loyalty in China as you do in the United States and Europe for Apple, right? Like it's not really a must-have anymore there, because it was a must-have because of its functionality, but now you can copy the functionality. And then with regard to Amazon, your second point, no, they're definitely different use cases. So the question on Temu is it a fad, a gimmick, or really here to stay? So I think all of us can agree it's pretty cool when you open up your Instagram and see some really interesting products like for your dog or water guns from Temu, and you make a couple of purchases. But I think people really are not buying everyday items from there, and Amazon has become so ingrained in everyday society and habitual routines of people, like that if you just want to get ordinary household products, you just buy it now on Amazon, and you're so used to using it in your phone. The ecosystem is so smooth. So I think that for Apple, it's more of a problem. For Amazon, it's less of a long-term problem. I think that the Amazon core use case is stickier relative to Temu, which is more of like the fad use case, and TBD if that's going to really move over to the core use case, but for Apple, it's really eating into the core use case. So that's how I would think about the difference in the two.
And Josh, you mentioned earlier CapEx. We've heard from all of the big hyperscalers, Google, Amazon, and Microsoft as well, that spending is going to continue. It's going to balloon as they invest more in AI. So as perhaps investors look away from some of these big tech names, given the investment in AI, do you see other firms benefiting from the spending from these hyperscalers? And if so, what are they?
Yeah, 100%. So if you kind of think down the value chain, by far the biggest beneficiary of big tech earnings from a fundamental perspective so far we've seen this season are the semiconductor stocks. And the interesting thing is that they have just gotten hammered over the past month and a half. And we all know how this works. Momentum cashes in a subsector in the market, either up or down. It becomes kind of a funds flow frenzy. And meanwhile, you have people selling an AMD from over 200 back in March to mid 130s today, down another 9%. Nvidia is still up a lot, but down recently. Micron from 160 all the way down to 100. But wait a second. If you go through these reports, every single one of these CapEx guides has been ahead of consensus for AI. Who benefits? Those firms. So we think that they're in a really interesting spot. Valuations are cheap. Stocks are oversold. RSIs are low. Stocks are like at support or even below. Meanwhile, all fundamentals are pointing in the right direction. They're dislocated, and we like them as longs. In addition to that, moving into 2025, we think that the semiconductor story has another leg to it in the second half of this year. And then the conversation will be about use cases for AI. Where is generative AI most real? And what's interesting to us is if you look amongst these large caps, Tesla. Why? Because like I mentioned before, now we're moving away from a period of time where people want cyclically linked economic growth, and instead they want secular TAM stories where they can get growth from secular nature away from the economy. And if you think about all these large caps, who really has it the most? Tesla. And what's the best part of it? Robotaxi. So we think that that's an interesting AI use case there that will benefit.
Oh, we're going to have to do this another time because I know that Tesla says they've got it, but have they got it? And that's what I want to know. But we'll do that on another occasion, Josh. Brilliant. Lovely to see you. And thank you for joining us out of Miami. Josh Corran, founder and CIO at Musketeer Capital Partners. Aj, lovely to see you as well. Thank you very much indeed for your time. Moving on, Intel sunk as much as 20% in extended trade after it announced it would cut 15,000 jobs as part of a $10 billion cost reduction plan. This off the back of a dismal second quarter earnings report. The beleaguered chipmaker missed on both the earnings and revenue, which came in at $12.8 billion for the quarter. Our US colleagues will speak to Pat Gelsinger, who is the CEO at 10 Central European Time. Don't miss that conversation first on CNBC.
And what we still have coming up on the show is this. The Bank of England delivers its first rate cut in more than 4 years. We'll bring you our interview with Governor Andrew Bailey next. Plus, AXA confirms talks with BNP Paribas to sell its asset management business in a deal worth as much as 5.4 billion euros. And finally, second quarter expectations. We will be speaking to the CEO, Luis Gallego, in a first on CNBC interview. That's at 9:15 CET. Stick around.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Welcome back. The Bank of England finally delivered its first interest rate cut in more than 4 years, taking its key rate to 5% from 5.25%, sending the pound to a one-month low versus the greenback. The 9-member rate-setting committee voted by a majority of 5-4 in favour of reducing borrowing costs from a 16-year high, calling the decision, quote, finally balanced. The hawkish cut came with a flurry of new economic projections. The central bank raised its 2024 GDP forecast to 1.25% from a previous forecast of 0.5% back in May. And on inflation, it said it expected headline inflation to rise to 2.75% in the final quarter of the year before falling back to 1.7% after 2 years. The governor, Andrew Bailey, told me that progress on inflation triggered the decision to cut rates.
Things like services inflation and wage numbers come down quite gradually, but they are coming down progressively. And it was really further confirmation of that trend. Now we're going to have to continue to watch this very carefully, by the way, because there's a way to go yet, quite a way to go yet. But that was the thing that. So it wasn't a new piece of information that changed things. It was more in the sort of sense of confirming a direction of travel.
I think you're typifying it today. Rather than a cut, it's a reduction in the restrictiveness. That may seem a subtle difference, but is that what you're trying to say today?
That's a good way of putting it. Obviously, it is a cut, but you're right. To actually characterise it, I think, as a reduction in restrictiveness is a good way of expressing it, yes.
Yeah. In terms of the key factors, we mentioned a couple of times in the press conference the two bête noirs that you've worried about mostly, service sector inflation and average wages. They are stubbornly high. They both have a high 5 handle still. Are you satisfied that we are making significant progress on both of those previously key measures?
I think what we're seeing is as you said, a gradual sort of path down of those things. Particularly on the wage front, we've seen nothing to surprise us relative to the view, for instance, we took 3 months ago in the previous report. Services has been a bit higher, goods has been a bit lower. They basically offset each other, so headline inflation's come out where we thought it would be. Have to keep watching, but we have to keep watching these things to see the path continue in the right direction. Our agents around the country, for instance, on wages, are saying they still see all the firms they talk to are saying, look, the path is downwards. We see that in our decision maker panel survey, the path is downwards. But it is a very gradual one.
Thank you for listening to Squawk Box Europe Express.
For more market moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.